Okay, good morning and welcome back, everyone, to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play. And we start off this week again on a much more, or rather, we start off this week again on a somewhat unsure foot with the equity markets. But um, over the past couple of weeks, we have started to make a little bit of progress with regards to starting to find some stability here in the major equity markets. And as of yesterday's sell-off, we did start to touch some major support levels that, if held, could be a potential buying opportunity right now. A lot of the call it current events with the tariff war or with the tariff trade war that have led to the excess volatility and the weakness that we've seen here across equities, bonds, and other asset classes. Those factors have largely subsided to some degree with regards to the uncertainty around them. At the moment, obviously, tariffs are very much still up in the air as to how they will roll out. But I think in many ways, the worst seems to be behind us. China and the U.S. at this point have largely agreed to not further retaliate with higher tariffs. We're nowhere near um, uh, done with negotiations with China. So, as far as how things will play out here, there's still in a lot of uncertainty from that perspective. But I think the market has largely reached a point in the news cycle where they're relatively comfortable with what we've seen so far and feel somewhat confident, if you will, or cautiously optimistic, I would say, that the worst is sort of behind us. And what's interesting is the fact that it coincides with, the major support level here on the S&P 500, which is around 5,100. Yesterday's sell-off here basically got us again back to 5,100, which potentially is a level where you do have a fair amount of support, and that's really where you could start to see a bit of a bounce here back towards the $5,500 level. We started off yesterday's session again saying that we're fairly cautiously optimistic, but that there was downside risk around 5,100 or so. So yesterday's price action brought us down to that 5,100 level, and the fact that we closed back above that level suggests that we could potentially be at a point where we start to find a little bit of stability here for the equity markets. Um, Yesterday, the equity markets got spooked a little with regards to President Trump's commentary over the weekend with regards to Chairman Powell and his desires for lower interest rates. And obviously, if the Fed's chairman was at the whims of what the president wanted, that was a concern for the equity and bond investors yesterday that justified the fairly significant sell-off here we saw yesterday. Um, and that at the moment remains a primary unresolved issue with regards to, does President Trump have the power to remove Chairman Powell? If he does, how much influence can he potentially have on the Fed? I think that we all agree that, generally speaking, that kind of influence is not particularly good, meaning it certainly has the propensity to drive monetary policy in a direction that is not particularly favorable for the US or the US dollar. So That's where we currently sit here from a broader macro perspective. And I think it's really important now to start paying attention to that $5,100 level, especially as there are signs that sellers are starting to get exhausted here on the specific move. We've reached kind of a peak bearishness in many indicators. And the question is whether or not we can start seeing a bounce here in the US equity markets going forward. And I'd say that we're now at a juncture where that's looking more and more favorable for potential bounce at the moment. If you look at the NASDAQ 100, 420 is a major support level here. We haven't quite reached 420 here on the NASDAQ 100, so there could be a little bit further downside here for the NASDAQ stocks. But largely, we've reached, the area of this major support level that we want to start seeing if the markets can hold. IWM still remains fairly weak here, but yesterday's move, didn't particularly have a significant impact on IWM, more so than other sectors. An RSP equal weight S&P 500 index also outperforming the S&P 500 on the back of, what is still a sector that is actually outperforming the market cap weighted indices. We continue to see value outperform growth in this particular market environment. Commodities that has rallied up to a major support level has now kind of been rejected a little bit here at that major resistance level, especially after gold reaching 3,500 and oil lifting off of the 52-week lows. There's a lot of questioning around whether or not the safe havens demand that the trade war has kind of forced upon investors, whether or not that has some further legs to go. At these major resistance levels that we're starting to reach, this is an important pivotal level to be paying attention to on gold. My hunch is that you could see a little bit of a stalling on gold at these all-time highs around 3,500, a little bit more consolidation as gold largely has traded in a one-way direction here over the past few months, really past year or so. HYG high yield corporate bonds. What's interesting is that yesterday's sell-off here kept HYG below a major resistance level that we've been paying attention to. We'd really like to see HYG get back above that $78 level to signal more of a risk-on environment with bonds, especially on the credit side of things. Any concerns around credit issues rolling over, spreading throughout the markets is a big concern here right now. Obviously, HYG is more high yield corporate debt versus treasury debt. We'll talk about that here in a couple of minutes. You have the VIX on yesterday's move, increasing back up to 33% after closing below the 30% level for the first time in a while. And the question is whether or not we can start to see this retreat back below 30% here on today's, if we get a positive move here on the S&P 500. If we can get below 30, any meaningful decline below 30, I think would be relatively constructive here for the equity markets, especially now that we've managed to revisit those recent lows at the 5,100 on the S&P 500. Now, the 10-year yield back near 4.4% is probably the biggest risk that we see to the overall market right now. And this is, if these risks start to escalate, we're talking some major, major risks with the US dollar and the US Treasury market, because the trade war, or rather the volatility from the trade war, has started to plant a seed in investors' mindset that US Treasury bonds may not be as safe as we sort of just take for granted, that they are considered risk-free assets, that there is effectively zero probability that the US government won't have enough funds to cover the payment of coupons for US Treasury bonds. And for a long time, that assumption largely worked and was true. Um, but as the US debt pile continues to rise, as interest rates have remained stubbornly high, as um, servicing the US debt load is now the second largest budget item on the budget. These are starting to put into question the sustainability of the $36 trillion of treasury debt that the US is currently carrying, especially in an environment where growth globally is starting to slow down. And that like I said, is the biggest risk that we see here with the broader markets, because if there is a loss of confidence in the risk-free nature of US Treasury markets, we're talking trillions of dollars of financial instruments that are priced with that assumption that is going to have to change their pricing model, or rather the inputs to their pricing model. And that's going to have some serious ramifications on the scale of financial crisis if we get a further deterioration in terms of the US Treasury markets. Now, we're not there yet, but we're starting to see some signs of concern from investors. And this is something that I think for anyone investing in this current market is probably one of the most important things to keep an eye out on, is where US Treasury bonds are trading and kind of what is the general sentiment for the sentiment and demand for US Treasury bonds. Alongside with the rise in TLT in the yields, we continue to see TLT sell off here. It got rejected at that 50-day moving average, which is starting to slope lower here. So if bonds continue to sell off, that's really the biggest risk. We've seen the US dollar sell off pretty substantially here. We're now well below 99 at 98 and a half. We're at a point where the US dollar positioning has reached a pretty bearish state. Whether you measure bearishness from a technical indicator perspective, from a positioning perspective, market breadth at the moment remains incredibly short here on the US dollar, which has the propensity to spark relief rallies from this sell-off that we've seen. So that's one that we need to pay attention to and look out for, are sort of these quick relief rallies in the US dollar that's going to offset some of the short interest that we're seeing here in the US dollar, and look for better opportunities to establish new bearish positions here in the US dollar, given the trajectory of where we currently stand for treasuries. You have the Bitcoin rally here above the 50-day moving average after oil kind of breaks out to a new low. You have gold reaching to that 34 level here, just shy of $35,000 on the spot gold market. And you have oil, after getting back to what effectively was the 52-week low at $65, we started to trade a little bit lower from that. So oil prices continuing to drop. Hopefully that leads to a lower inflation number and provides more room for the Fed to discuss cutting interest rates here for 2025 and how many based on their growth expectations. And then looking at sector rotation, this is really where we continue to see a real lack of rotation, which is not a particularly good sign here for the equity markets. And, as we are playing for a cautiously optimistic bounce here in the equity markets, we really would like to see a favorable amount of sector rotation that goes alongside with it. And at the moment, we're just not quite seeing that right now, because the two growth sectors that have led the decline, which is technology and consumer discretionary, both of those continue to be weak and continue to underperform the S&P 500. If you look at both technology and consumer discretionary, these just continue to look worse here, and without really any signs of a reversal here. And then flip side, you have sectors like financials that have continued to outperform the S&P 500 since the beginning of the year. You have consumer staples that have outperformed by a very wide margin since the beginning of the year and continues to outperform. You have healthcare that has outperformed the S&P 500. You have materials that has outperformed the S&P 500. You have industrials that have outperformed. So basically, you do have a lot of sectors that have outperformed, which is a good sign. With the exception of energy, utilities also has outperformed the S&P 500 by a very wide margin. So, again, just to reiterate, what we're not seeing right now is much sector rotation, and just all the defensive sectors are outperforming while the growth sectors are underperforming. We need to start to see a little bit more of a balance here in order to gain more confidence in the market rally here. So we'll continue to monitor that over the next couple of weeks and start to see if we do get a shift back towards some of the growth names from an outperformance perspective, and some of the underperforming sectors start to show some of that weakness here. So we'll be keeping an eye out on both the treasury market and sector rotation to help confirm our, like I said, cautiously optimistic views that we currently have started to establish on the equity markets side of things. Now, to explore some trade ideas here for today, let's start off with looking at some bullish ideas that we're currently seeing. So a lot of the consumer staple stocks, look fairly strong here. So, for example, Colgate-Palmolive, no matter what, you need to brush your teeth and utilize a lot of the products that they make here. As you can see here, what we have is a stock that has underperformed the S&P 500, started to form a base and starting to break out here. We're looking for potential continuation on something like Colgate-Palmolive. The other chart that I think is worth paying attention to here is Coca-Cola. Coca-Cola broke out here above that $72 level here. We're looking for a potential continuation above that, and note how much Coca-Cola has outperformed the S&P 500 since the beginning of the year. So you really have a set of indicators that are pointing quite strongly for Coca-Cola that I think is worth paying attention to here at the moment. We have Fidelity National. Oops, not Disney. FIS is the symbol that I was looking for. Very similar setup to some of the other ones that I've shown you, from the perspective of you have an underperforming stock that has now formed a multi-month bottom here and started to break out here to the upside. Our upside target here is just shy of $90 to the upside, currently trading around $76 or so for FIS. And then looking at some potential bearish opportunities here right now. One other stock that I want to point out here that kind of falls into a very similar category is Procter & Gamble. Procter & Gamble, not a particularly sexy trade, but in this type of market environment where you've got a lot of volatility, you got a lot of downside risk, stocks like Procter & Gamble, with a really, really strong net margin, are the ones that are going to do better in this type of market environment. That's why we have Procter & Gamble on our list for our own portfolios at the moment. And then looking at some bearish opportunities here right now, Costco remains, at the top of my list with regards to bearish opportunities. Whoops, let me see if I can get this back. If you start to look at Costco, this is starting to look like a bit of a head and shoulders top. So, the neckline here is coming in around 900. That would be my initial downside target, but really what we're looking for is breakdown below 900. And that starts to put, a 780 here to the downside into our downside targets here for Costco. And we've got a lot of retail stocks that fall into a similar category here. You've got Walmart, where you've got this kind of what looks like a bit of a topping head and shoulders formation that could potentially start to lead to some weakness here, that I think is worth understanding. The other one that I think is worth taking a look at here is Eli Lilly. We've had a jump here for Eli Lilly that I think could be a potential entry point for a bearish trade here. You basically have this jump here, this gap higher here that has now failed, and we continue to make a series of lower lows and lower highs, and that leads me to believe that we could see some downside here for Eli Lilly. And then looking at some opportunities here. Now, I always hesitate to talk about stocks that are $1,300, $1,400 stocks, but I'll just leave this with you for those of you that do have relatively large accounts, or if you're trading options to gain some leverage using a deep in the money call option, or just simply buying a short-term call option on a particular stock, you might be more immune, if you will, to the actual price of the stock itself. So I wanted to share the opportunity with everyone so that you can see the potential here. As you can see, O'Reilly Auto Parts, continues to be on a straight and up to the right arrow here. They are quite successful in terms of their growth expectations and profitability, and that's really what's led to this steady and up to the right start that we continue to see for O'Reilly Automotive here. In this type of market environment, I think this is the stock that will likely thrive, including some of the stuff from, yeah, these are some of the stocks that I think can potentially thrive. So with that, that covers what I wanted to share with you here today. Hopefully this gives you a better understanding of how we are taking a more cautiously optimistic tone here in the broader markets, and the specific trade ideas that we're starting to pay attention to as we take a more cautiously optimistic tone in the broader equity markets. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here next week.